Good day, everybody. We are back with another portfolio management explainer video. This week, I am going through a potential client's portfolio. So this is actually a real life example of a portfolio from another advisor. And I should disclose this person, one, I changed the name, so it's completely anonymous. But this is an actual portfolio, and this potential client actually did end up becoming a pure client, for full disclosure. But again, there's no details released other than the holdings, because it's a really good example of what we see every day. And I think there's this belief among both the investing public, so potential clients and those working with other advisors, and within the advisor community, that all advisors are the same. Investing is a commodity, meaning you could go pretty much anywhere and get a sound investment portfolio. And I'm telling you, based on what I see in my almost 20-year career, that is not reality. We see all sorts of pitfalls and traps and misallocation mistakes, portfolio management 101 breaches, if you will. Like simple stuff a professional investor would not miss is getting completely missed, either through ignorance or greed or being a cog in the corporate system where you have to invest a certain way. And I'm going to pick this portfolio apart. Again, not trying to throw anyone under the bus, but I think in 2022, you can hire a really good professional investor and complement that with sound financial planning and really good advice. Sometimes I think amongst the advisor community, we get, you have to be a professional investor or a financial planner advice type advisor. I think we can embrace the power of and we can bring both under one roof. Okay, so enough of that. I'm going to share my screen. And again, apologies, I'm getting over a cold, so I might sound terrible. So for the sake of identity, we're going with my Lasso Opso Bush Shermans today. He's back for another round. And I'm going to go through just some high-level stuff, some low-hanging fruit, if you will, that you might be able to apply to your situation, whether you're a do-it-yourself investor or you're working with another advisor. It's not a stretch to say 90% of our clients come from other advisors. And this is the type of stuff that I point out to those potential clients, things that we can clean up. And a lot of this has nothing to do with what I think the market does next, right? So this is stuff that you don't have to be a savant. You don't have to be an expert. You just need to know where to look, and you can harvest the low-hanging fruit and give yourself a higher probability of a successful outcome, whatever that means for you. So the first thing is, and I'm seeing a lot of this coming off the heels of a golden decade from 2010 to the end of 2021, with some exceptions. That's been a pretty good period to be an investor. I call it the golden decade, where it basically was uninterrupted gains with not a lot of underlying risk. Markets do move in cycles, and I've been quoted as saying periods of stability breed periods of instability. And a lot of people want to look at what's going on now. The world is burning. It's like, this is just a market cycle. Markets move in cycles. Periods of comfort are often followed by periods of discomfort. And I think that's what's happening now. So how that manifests itself is you get people, investors, that end up taking more risk than they're comfortable with. So how that manifests itself is you get investors taking more risk than they set out to, right? So being more heavily allocated to stocks than they usually would be. And I think an upmarket, a long upmarket, like 10 years, can create a false sense of being a risk-seeking investor, right? It's easy to embrace risk. It's easy to seek risk when stocks are going up. It's easy to shun risk when stocks are going down. And unfortunately, investing doesn't work that way, where we get to enjoy the fruits of the upmarket without experiencing the pain of the down market. Okay. So it's been said, everybody's a genius in a bull market. I think that's a really good saying, because it can create a lot of false conclusions. So a common theme that I'm seeing is an investor with a risk score of 32, right? So on a scale of 0 to 100, 0 being an all cash, being a conservative investor, 100 being 100% stocks, being an aggressive investor. 32 would be on the conservative side of moderate, let's say. Okay. So this is how Bush feels about risk, on the conservative side of moderate, for lack of a better term. This is how Bush is actually invested. So we actually loaded Bush's holdings based on Bush's company 401k. Bush works at Big Cecil, and Bush works with a strip mall broker. Okay. So taking Bush's assets and combining these two accounts into one risk score, you can see Bush is on the more aggressive side of moderate. Okay. There's a pretty big disconnect between how he feels about risk and how he's actually invested. Now, again, in an up market, you wouldn't really care about this, right? You're enjoying the fruits of being a little more aggressive on the upside. But 2022 rolls around and you're hanging out in this neighborhood and it doesn't feel very good. And you might throw your hands up and say, hey, what the heck? I didn't know I could lose 12% in 3 months. I didn't understand that was a potential outcome. I'm more likely to abandon my well thought out investment plan. In this case, it wasn't very well thought out because you can see this big gap here. So this is probably the biggest and worst mistake that we see, right? This range of outcomes is much too wide, especially on the downside, given this attitude towards risk. So ideally, we would build a portfolio that has a risk score of 30 to 40. And what that would do, it would tighten up these range of potential outcomes. So instead of up 18%, you might be up 12% in a normal range of outcomes. Instead of down 12%, you might be down 7.5% or 8%. This range of outcomes, this tighter range of outcomes, is much more consistent with how Bush feels about risk. If Bush understands he could potentially lose 7% in 6 months, and he's not surprised by that, he's more likely to stick to his asset allocation. Okay, so that's what we want to get to: building a portfolio that reflects the way our investor feels about risk. I say this all the time. Longtime clients and readers are probably sick of me saying this, but again, the time to make portfolio management changes and to get this in line with this number here, 59 in line with 32, is not after the market dumps by 30%. Okay, the time to do that is right now. So that's the first thing: risk mismatch with how they're invested versus how they feel about risk. The second thing I see is, and we've been reminded that investing is hard. Let's not make it harder. But this portfolio is littered with a mutual fund salad. Like, this is just it's like someone threw up a bunch of mutual funds and ended up with this. You know, I'm a big fan of intention, and I couldn't think of a less intentional portfolio. Now, I'm going to hide part of my screen, but if the average person, or even the average advisor, or someone that does this for a living, was to look at this portfolio and I was to ask them, what percentage of stocks, what percentage of bonds does this Bush Sherman's own? It would be very hard to tell. Okay. And that's very basic. Like, if you showed me a statement within 30 seconds, I can tell you a lot about not only the advisor, but the investment portfolio. It's not so obvious here, right? And if I drill down even further and say, what percentage of this portfolio is U.S. large cap stocks versus U.S. small cap, value versus growth, international versus domestic, you would have a really tough time coming up with that answer unless you had a trained eye. Okay. And not knowing what you own brings in a whole Pandora's box of problems. You don't understand your risk exposures. You don't understand if the market cycle turns, what the downside is. You don't understand if you have an over allocation to a certain sector or stock. Like, if I said to you, how much Microsoft does each one of these equity mutual funds own? It would be impossible to tell. What if every one of these mutual funds owned a 10% position in Microsoft? Well, our friend Bush just unintentionally has an over allocation to Microsoft. He might like that company. He might hate that company. At the very least, he should know what he owns. The story is, it's very hard to know what you own when you have a hodgepodge of mutual funds. I call it a mutual fund salad. And guess what? Every one of these mutual funds is managed by their own separate team. So if you look at this portfolio, you might assume the strip mall broker is actually managing this portfolio. That would be an incorrect conclusion. Actually, this has about 15 different managers located all across the country that don't know each other, that are all managing pockets of this portfolio in silos. What could go wrong? Okay. So this is just not an effective way to manage money. Unfortunately, this is how many advisors manage money. And again, it's just impossible to know what you own. It's really hard to know what you're paying. There's no coordinated risk management strategy. It's just very unintentional, for lack of a better term. Okay. Now, this particular strip mall broker was charging Bush 1.35% times 1.3 million plus an embedded mutual fund expense of 0.44%. So add that up. What is that? Close to 1.8%. That's pretty egregious in 2022. So not only does this violate many portfolio management principles, they're paying a ridiculous premium for it. And contrary to most premium goods in finance, you don't get what you pay for. So if you're paying up for it, that just means you're getting less money. It doesn't mean you're getting a premium service or a premium product. It means you're lighting money on fire. Okay, so this arrangement is good for our strip mall broker, not good for our client, good on our client, Bush. Now that's our client, for paying attention and sniffing out something was wrong. And then the last thing about these mutual funds, but defenders of mutual funds and investors in mutual funds say, well, you have the potential to outperform. You have the potential to outperform. Okay, if I'm good at picking mutual funds, which by the way is a skill that doesn't exist, but let's say I'm good at picking mutual funds, what are the odds that I'm going to pick funds that outperform? Well, fortunately for us, there's an institution that tracks this. So it's called the SPiva Report, and it's published by S&P Global. Okay, and what the SPiva Report does is it looks at various equity asset class styles. So like large cap growth, large cap funds in general, large cap value, mid cap, small cap, and it basically compares mutual fund performance versus the benchmark. Okay, and mutual fund performance is dismal relative to their benchmark. All right, and I'm not going to belabor this or go off the rails on this, but they just published their end of 2021 report. That's what I'm looking at now. Large cap funds continued their underperformance for the 12th consecutive calendar year as 85% of active large cap funds trailed the S&P 500. So that means out of all the US large cap funds, for the 12th consecutive calendar year, 85% of those funds trailed the S&P 500. So I don't know about you, but I'm a fan of evidence, giving myself the best chance of success. Like if that was a casino and the casino said every player that comes in here has an 85% chance to lose and only a 15% chance to win, that casino would go out of business. But because of the Wall Street marketing machine, the advisor marketing machine, you get portfolios that look like this, which again, investing is hard enough. We want to optimize the things we can control to give people the best chance of success. The best way to do that is by stripping out a lot of this nonsense that's proven not to work. Okay. So if you work with an advisor, you might like that advisor, but if they're using mutual funds, if you don't know what you own, if you don't know where your risk exposures are, if you don't know their strategy for rebalancing or making buy-sell decisions, like if someone asked me to rebalance this account, I wouldn't even know where to start because I don't even know what I own. Okay. That's a problem. Start asking questions. And you can start with many of the questions many of the statements that I just rattled off. How do you make rebalance decisions? How do you manage risk? How do you know what I own? How do you know that these 15 mutual funds all don't own the same stock in their top 10 holdings? Why am I paying another 0.5% when I can own a similar asset class in the form of an ETF for nothing, or basically nothing, a fraction of the cost? Okay. If they say investing is a commodity, I don't really see it here because this is not based in sound investment principles. Okay. Let's look at the 401k really quick, a real quick observation, because I know a lot of people own target date funds, right? So 401k plans, in an effort to help people save and make it easier to understand, started offering target date funds. And I think that's fine. But again, looking at this target date fund of 2035, you don't know what you own. Like this could be 70% equities. This could be 80% equities. It could be 50% equities. That's the problem I have with these target date funds. And in general, a lot of these target date funds end up taking more risk than this 2035 number would imply. And this, I mean, look no further than the 2008 crisis, where a lot of these target date fund companies got sued because they ended up investing way more aggressively than people thought they were invested. Where, let's say, a target date retirement of 2015 was invested in 75% stocks, right? In 2008, you would have had 6-7 years until retirement. That's a pretty heavy equity allocation. The market crashed, people got crushed, and they ended up suing because they didn't understand the risk they were taking. So you should be able to go into your HR department or the website that services your 401k plan and drill down and see how much equities you actually own in this target date wrapper. Okay. So to wrap this up, again, I'm not picking on anybody. There's plenty of good advisors out there. There's just a lot of bad advisors too. And it's not intentional. A lot of good intentioned people go to work for big Wall Street firms or strip mall advisors or non-fiduciary advisors. They're just a cog in a system that doesn't reward or incentivize client outcomes. They're in a system that incentivizes sales and commissions and just throwing random portfolios together. So it frees up that advisor to go out and gather more assets under management and sell more stuff. So this is not picking on anybody. The message is not all advisors are the same. In my opinion, an investor working with a wirehouse, a publicly traded company, a big bank would be better served with an independent RIA, better served with a robo-advisor, a fiduciary advisor, because when push comes to shove and you have the choice between maximizing the bottom line, maximizing returns for shareholders versus doing the right thing by clients, I mean, we've seen it time and again. The former wins out every, right? This is 2022. People have options. There's plenty of good independent advisors out there. People that want to do right by clients don't go work for a big Wall Street firm. I mean, they just don't. So find an independent firm that puts clients first, that only answers to clients, and you'll see better outcomes on the incentive side. Investment performance is magically going to be different, but your fees are probably going to be lower, and that's a great place to start. And then if you own mutual funds, or if you can't tell what you own, if you don't understand how your advisor dials up risk or dials down risk, you don't understand the context for when buy-sell decisions get made. If you don't understand why you own a mutual fund when you could own a either lower cost share class or own an ETF that is much lower cost, start asking questions. If you don't understand what you're paying for advice, start asking questions. If you don't understand what your fee entails, whether it's financial planning, whether it's estate planning, tax advice, investment management, start asking questions, because I can tell you, folks, there is a Grand Canyon difference between advisors in 2022. Not everybody's the same. Okay. Fees matter. Incentives matter. After-tax returns matter. Risk management matters. It's easy to gloss over this stuff when the markets are going up. Okay. When the markets turn, when cycles turn, which they always do, to borrow a phrase from Warren Buffett, the tide comes out, you see who's been swimming naked. It's time to start paying attention to this. Investing is hard enough. Working with these non-fiduciary brokers and investing in mutual funds, that's like running a race with your shoes tied together. Okay, there's a better way to do it. Thanks for watching. I'm off my soapbox. If you have any questions, feel free to email insight@pureportfolios.com or respond to the Sunday Coffee Reads email. Thanks. Bye-bye.